Investor Tom Wisniewski knows what companies need to get funded. He's a New York angel and the managing partner at Newark Venture Partners, and he's leading and investing in large seed rounds and specializing in B2B software. Stay tuned for his take on what you need to do to raise money in this more difficult environment. Welcome back to another edition of The Angel Nest, where real angel investors and entrepreneurs partner to build great companies. This is another in our series of podcasts with Johnnie Walker of Rooled, Outsourced, CFO and Accounting Services, and we're talking about how founders are getting funded now. Rooled are the startup finance experts. Thanks for joining again, Johnnie. And everyone I talk with lately says you're really on the right track here, focusing on how founders can raise money. It's the number one problem for startups.
Yeah, no, great to be here again, David. And I think this year this is the big topic. So very glad to be covering it again.
That's great. Looking forward to our discussion today with Tom, who is the managing partner at Newark Venture Partners, where they're now expanding beyond their roots to invest in world-class B2B software. Founders will be happy to hear that you lead rounds and write $1 to $3 million checks at seed stage and focus on fintech, e-commerce, including marketplaces, which some investors shy away from. And you're doing a lot of work with digital health. Tom, thank you so much for making time to join us here today.
Oh, thanks for inviting me. Good to be here.
All right. So what investments are you finding attractive, and how can we help founders fit into this new paradigm?
Yes, I mean, I would echo what you guys are saying. It is a difficult environment. VCs are sort of finding a reason, or investors generally are finding reasons to not invest, looking at lots of things, holding off, getting through multiple rounds. So I see kind of both sides of the market with the large portfolio of 100 plus companies, and then also in being a VC and looking at new investments. And it's one very time consuming, I think, for founders at the moment, and can be kind of a little disheartening, unless of course you're some kind of a hot AI company. But we'll put those aside because those are the few. If we're talking about the bulk of companies out there, it's a challenging environment. And I think that having your act together before you get out there and get going is just one part of the sort of must do, I think.
Right. So Johnnie's in the business of helping companies arrange themselves, both to extend their runway and to appeal to investors.
You're here. We like the sound of that.
Yeah. So how do you look at that? And do you look at those numbers and those presentations differently than you used to?
Yeah, I mean, first what I would say is there's just a marked difference between someone who's thoughtfully prepared themselves to go out and raise and had someone at their side like Johnnie, or someone who's knowledgeable about what's going on, right? Maybe that's you. Maybe as a founder you've done it before and you've been out there in the market. But for a lot of founders it's their first time, or maybe their second time, but not as the lead. So that preparation to get going, I think, is critical, because you just don't get that many chances to get kind of a first impression. I mean, what I would say in the current market, having product in market, right? If you're pre-seed bordering on seed, critical. Used to be, I think there was a time when ideas could get a bit more traction, but outside of AI and some craziness, really need to be at that stage, generating some level of traction in the market, be that with revenues, or be that with client usage, or that sort of thing. I think it's just ever more critical to have the not just the story, but have some evidence out there that the story that you're telling and that the product you have and your vision is getting traction. Beyond the fundamentals of that, I'm exploring a lot of ideas that are at the cross section of enterprise software and AI applications. So not trying to create the next LLM or figure out how to serve those guys better, but what can you do with this new technology that solves a thorny business problem in the enterprise world? That's what's kind of been occupying a lot of my time in the last, I would say, 6 months. Prior to that, I'd done a fair amount in marketplaces. I still look, but a little less, I would say, in the current environment, because it is a funding challenge to get those kind of companies funded, kind of in the current deficit of seed capital.
With that, companies, it seems like all the milestones, effectively, what applied at Series A is kind of now applying more towards the Series C type
good
thing. Point.
So
everything's sort of it's been advanced, if you like. And certainly with what we see in the client base is that when you've got companies starting to generate revenue, that's when the complexity in the finance and the accounting tends to it goes up, and you need to start reporting things correctly so that you've actually got the ability to track traction properly, measure margins and unit economics and things. So do you, when you're working with your companies, do you see that kind of, how do you find the companies deal with that pressure, and how do they best respond to that?
First of all, I would
responsibility,
completely
like.
agree with you. I think there was one of the benchmarks as a seed investor and looking to finance companies and then help them along for a couple of years and get them to a Series A. That bar for Series A has moved dramatically. And there was a time when call it a SaaS company, common sort, with a run rate of $1 million a year could expect with a decent growth rate to be out there and get meetings and have some traction against the Series A. I would say that number is more like 2 to 3 million now.
Yeah.
And with more logos, more sophistication in the company, a lot more kind of proven out. So the goalposts really have moved quite a bit.
Yeah.
I think that's left a lot of companies in that kind of in that gray zone of needing seed extensions and such.
Yeah.
And if you're good, you can get those done. Yeah. So I think that building off of what you said. One of the pitfalls you see out there with companies, right, and then to get to kind of maybe how to stay out of that is if you hire just a plain accounting firm or you end up working with an accounting firm, sometimes the financials that they'll produce will just be overly complicated and way too GAAP and sort of set up in some generic template that maybe serves a typical company, but has millions of kind of line items for a G&L that they don't really, GL they don't really need, or for whatever other reason. And then on the other spectrum, it's something that's been just cobbled together in Excel, but hasn't put a lot of thought into it, and doesn't look like it has any real connection back to the actuals. For instance, if it's a set of projections and such. So trying to take that sort of level of sophistication that you ultimately will need to get to as a larger company, but what are those critical points to blend that with, well, as a seed stage company, what are the 10 most critical things that you need to have set up? And one of the discussions I was having with David earlier was that what I counsel founders is that there's a set of numbers, call it 5 to 10, that you should be able to know right off the top of your head. Doesn't matter if you're the numbers guy in the company or not, and probably anyone in your C-level should have those. And they include kind of what's your runway, what's your burn, what's gross expenses, the net burn, kind of coming out of that. What are the what are the revenue projections for, say, the end of the year or a year from now, and having a command of those just verbally. And that's sort of the beginning, right? And then there are levels of detail deeper and deeper, and being able to bridge that gap between the things you can just talk about and then that model that ultimately investors are going to want to see is that along that continuum is often how I'm coaching people.
Right, got it. Yeah, no, and I heard you loud and clear that there's a sort of there's a sweet spot in terms of the complexity that you put into the accounting that you need that to get the job done and actually do the financial reporting correctly and do things like annual federal and state taxes and compliance and whatnot. But you don't want it to go beyond what is reasonable and needed at that point. And I think it's when revenue turns up. There's obviously some very basic requirements like equity reconciliation, make sure that the cap table ties out to the balance sheet.
Yes.
But the revenue is really where that measurable growth and traction is going to come from. And I think I obviously totally agreed on the metrics too. That's where we find there's accounting to get the statements together, and then often there's a little bit extra translation into understandable metrics. And because once you've got some accrual-based financials, kind of that access to like what's happening on the cash side is a little bit disguised. It's on a cash flow statement, but it's kind of not as obvious from it. And that they are finding when people want to talk about cash, like you're often with founders, if they've been through it before, if they're financially knowledgeable, they kind of tuned into it already. But with a lot of time, I find that you just got to do a little bit of translation coaching. This is what the numbers mean, and this is how you get to your net burn number. I think some CFO expertise, even at that very early stage, it can be very light, but it just helps provide that.
Absolutely, and I you know your way around this. I mentioned it that dichotomy just sort of set up the playing field, if you will, of what I would I can often see, and you can do it too much, obviously at this stage, and it's not hard actually, but too little is not going to help you raise any money, right? You're not going to. You're just not going to get there. And it's interesting because I think that in a perfect world, as a startup, accrual and cash would be the same.
Yes.
Right. And if you happen to be that company that gets paid monthly, right, this magic occurs. And because there's not very much in non-cash expense in the way of a software startup, they basically are the same thing for purposes of investors and and certainly for the founders already. However, that's probably the minority of companies these days, right? Even if you're a software company and you're SaaS and you're getting paid, you're often getting paid annually, right? Or that's the case, and then that sets up this dichotomy between accrual wise, you earned a 12th of that every month, but the cash only came in 6 months ago, or is going to come in 6 months.
Exactly.
And that sets up a different sort of conversation.
Yes.
And if you're talking about how founder might get tripped up or show me a command of something, it's being able to talk both of those languages fluently, simply, in a way, because obviously they both matter. One gives you an understanding, accrual-wise, of how are you earning, where are you at, but trying to then be able to quickly reconcile that with cash is important, especially as you're coming down to the last few months of your runway, for instance, getting ready for financing.
So interesting. How many founders are focused on all of this? Probably not too many.
Well, they get really focused on it when runway starts to get tight or when they see the current environment. I'd be surprised. I would say in the last year I've seen a lot of them step up to really understand that, right? And then it gets more and more, that understanding gets more and more crisp for good founders, right, who are in tough situations as they get down to it. I would say there's a statement that I'm used to seeing, and sometimes I have to ask for it and sometimes not, when we're down to like, all right, we're close to break even, but we're not there yet. Or we're break even, but not consistently because we only get paid once a year. Yeah. And what you end up seeing is, all right, there are our regular monthly financials, mostly kind of looking at them accrual. And then there's the weekly cash flow statement, which has to do with when they really expect an invoice to get paid, right? Which is very different than it's this month or whatever, but you're watching that. Yeah. And now that's just the reality of where you are sometimes as a founder. I've been a founder, many times in my life. That you need to be able to do that. Yeah. And I have a lot of respect when someone whips one of those out and they're like, no, I know when my money's coming in. I'm concerned because I only have sort of 3 months. It's 3 months. It's a rolling 3 months. But okay. Yeah. You've got command here. You know when you have an estimate of when this is coming in. If I point to something on that sheet, it's not, I've got a $50,000 receivable. It's these two invoices from, from these clients that I've been working with for a while, so I know it's coming in.
Exactly. Yeah, and I think one of the things we always really encourage with these plans and forecasts and stuff is a regular update of them. And obviously, the weekly forecast, you get the opportunity there to put in whatever activity did happen at the start of the week. By the start of the following week, and then look and see, where were the assumptions wrong? And how does that then inform the rest of the forecast going forward? And I think that, you're looking at a forecast and saying, okay, it's been updated to just the prior week or the prior month. You've got somebody who's really paying attention to it, and you got better confidence in what the forecast is because they've kept up to date on what actually is happening in the cash. So I completely agree with that.
Another one that I would say, if we're sticking to this idea of the what's driving the financials or driving the performance, that linkage, and I think you mentioned it in passing there, between the metrics, right, which I would say are sort of fundamentals of what's going on in the business, the clients or volumes that are passing through the software, and the dollars themselves, right, and the founders that kind of have a command of those, right, who see that linkage there and are able to talk, even as simply as the number of clients they have of different sizes translates into what they're projecting in terms of their ARR.
Yes.
As simply as that. Because ultimately, revenue doesn't generate itself, right? It has a driver, and easiest way to think about that one step removed is its clients. And you don't have a sense of you're projecting $100,000 by the end of the year, and you can't say, well, what's that mix of clients you're expecting? Yeah. How much of that is already in your sales projection with a name against it? How much is still out there as a projection? That's a problem. And if you do have that command, again, that's something that you think, wow, okay, that's impressive. If someone can.
There's that sort of technique or approach where you've got a real solid understanding of what's happening right now, and then it becomes a case of where you put numbers in a projection, but if you can articulate how the business dynamic that is occurring currently then evolves to that. So you talk about ACV growing because you're folding more services or more products into it. At least you've got some known quantity right now that you're extrapolating from. And that, I think the founders that have that knowledge of current then have a much more explainable and persuasive forecast.
Yes, and I would say I call that the linkage between the actual and the forecast, or the actual and the projections going out, right? It's nothing less credible than your actuals. You don't know them, maybe in the worst, or you do, but they don't match up even with what you're projecting you're going to be doing next month.
Red flags everywhere.
Red flags everywhere, and you kind of, as a founder or former founder, understand how it can happen, because it's how often are you going to get around to updating numbers, that sort of thing, or you pass through a month and there's been a close or hasn't been one or whatever. But that's there's a bright line there with credibility.
Yes.
If your actual expenses, you don't know them, or if they're not jiving with what you're telling me is going to happen, even in the next couple months.
Yep.
Because as a seed stage investor, I obviously care that you're pointing, north and expect to be at 50 million in 3 years, but I'm really focused on credibility in that current, realm of like what happened the last 3 months and what you expect to happen next month and after that. And then I really care about your monthly projections for the 6 months, the year, maybe 18 months. Beyond that, we kind of know it's modeling.
Yes.
I want to know that you've been smart about it, but I'm going to spend most of my time looking at those periods there. So you should expect that.
Yeah.
And depending upon where you're in the calendar year, that can mean different things. Where we are right now, I would expect you to have a very good understanding of what those projections look like between now and the end of the year, and have a pretty buttoned up projection of what your ARR and your run rate is likely to look like by the end of the year. Because that's just the kind of time frame we think about.
Yeah.
And then I would expect there to be a model that I can look at, right, that would show me reasonable projections for 2025. Yeah. Beyond that, annual would be fine.
Yeah, exactly. It kind of decreases in the granularity of it. The further out you get, it's less granular. It's more sort of like summary, but at least you've got to have some ability to justify it. But it is that nearer term where you have every reason to be accurate about the forecast and the detail.
Yeah, and then getting in there and it's looking out. As someone just said, "Hey, I'm going to grow at 7% a month," and then backed into how many clients that going to be, or is it built up by? I've been acquiring 10 clients a month at 1,000 each, and that's driven that. I know I have a couple of named ones out. Do you have that level of sophistication? And that brings up another thing that I do look at is, if you're you're selling SaaS software in that context. A lot of the companies I'm looking at are doing that. Let's say they're somewhere between. They're an enterprise software company, so that would be maybe tens of thousands of dollars up for the kind of ACV, average contracts they're selling. You would expect that for any revenue growth or projection for the next 1, 2, 3 months, that has a name against it.
Yeah,
right?
Yes.
And then at some point, you can't put names against things that are 6 months out, right? I mean, you could, but then you'd actually be making a mistake.
Yes.
I'd be looking at you and going, how do you possibly know that? So there's this subtle bridge between I want there to be clarity and absolute sort of not certainty, but names against those numbers for the first 3 months. But then that has to bridge into, well, I've got a projection and I'm going to, you could look at my funnel and it's got something that looks like it's 6 months out, but the reality is I'm expecting there to be 3 closes that month. Maybe it's, why should you believe me? Well, now we can look at your funnel and say it looks like there's a healthy number. Yeah. So there's that balance between accuracy and precision that you kind of want near in, but trying to make that transition into a projection and the reality that, 6 months out, it's going to be a projection.
Yeah. No, totally. And I think it's about managing all those moving parts in a financial model. Certainly as the company grows, there's a greater number and scale of deals that are live, and back to the sort of SaaS type model. You, as certainly in putting a financial forecast together on a monthly basis, you want to be able to accurately project what the revenue is going to be 1, 2, 3 months out, the recognized revenue, not even just the recurring revenue. That requires a really solid understanding of the current contract base, renewal rates, likelihoods, etc., and what's going to happen with that revenue. Because we get measured by investors on the accuracy of new ARR and churn and whatever in terms of the month or the quarter, but also on the recognized revenue, because obviously that's a GAAP accrual-based revenue, and that's you need accuracy and you need sort of focus and the detail to do that. Yeah, definitely.
So we're talking a lot about metrics, but I'm curious, Tom, if this environment has changed the kind of companies that you invest in.
Kind of companies? No, I mean, I would say I think that in the broader sense, you look for something that's exciting, right? And you could define that lots of ways. That looks like it has potential to solve a thorny problem and therefore get traction in the market. I'm looking at B2B software, so trying to understand how, why, in the case of AI software or something new that's come along, is going to be able to crack a nut that hasn't been, cracked yet. That getting excited about a company like that, I would say that hasn't changed. Still looking for those ideas and thoughtful founders and traction.
Are there different kinds of companies that thrive in a higher interest rate environment, or is that not really material at the start?
Well, let me continue the thought, and I'll strike that. So I'd say yes. What has changed, and this is a component of it, is I have to think about what the next round of financing is going to be, right? And even if I have a screen for how I'm going to do it, I got to be very thoughtful in a tight environment. Is how fundable is this company to the next set of investors upstream from me, right? So that would be if I'm solidly seed stage, I'll do a little pre and I'll do a little bit of Series A. I'm looking at my Series A partner, funds, trying to understand what they're looking at and whether that set of goalposts have moved and how tolerant are they to missing a projection. So in that sense, I become a lot more concerned about, can this company really hit that kind of a metric? Can they get to that 2 to 3 million number, in 18 months, right? Or is that unrealistic? And I need to build into my thinking there's going to be a seed extension. So I would say, I think we've changed our, as those goalposts have changed, we've changed our tolerance for risk, right? Because it's less easy to get a company financed if it's not sort of thought to be kind of a leader somehow or in a hot sector or whatever it is. In terms of you mentioned interest rate environment. I use that when people say that. I use that as a kind of an adjective to describe the tight environment we're in. I don't know that a lot of VC investors think a lot about the alternative between putting their money in the bank or in a CDs or even something that would earn a more reasonable rate and whether they should invest or not. I think that there's at the margin that probably matters less. I think what you can see is obviously if the market's up, there's a wealth effect, especially for angels and for early stage investors. It affects everybody's next investor up the food chain, right? That matters. So I don't know that I see any direct correlation. Direct being the rate changes or people thinking about rates at our at our level in the seed stage. Maybe other than, I guess, occasionally for debt, but even then, it's usually a minor kind of concern. As an adjective for it's a tight environment, and LP money, limited partner money that's going into funds, they are really thinking about interest rates and where they could put their money, and that obviously affects how many are re-upping into new funds, and we talked about kind of that there's a startling gap in the market with funds that were active, say in 22 and no longer active in 2023. The PitchBook data said it was something like we lost 40% of the funds being active, right? Active in one year, no longer active in the next. And I think probably a lot of that may be driven by LPs thinking about the balance of where they of risk associated with venture capital, and that certainly has had an effect, right, on the market.
And do you see many companies accessing venture debt alongside some of these seed deals that you're placing? How do they?
I've always been a skeptic about debt at the early stages, and I think the answer is yes. You do see it. I think when the market was flush a lot, and I really wondered about the people who were loaning these companies money, even some of mine. You think like my equity is really risky, but I'm expecting that, putting it in there. I don't see how you call this thing you put in there debt, given the dynamic of what's going on. I think that the traditional debt game that's out there, I think, tends to exist farther upstream than or downstream from seed, in Series A and B and beyond, where a company's doing a big round or doing a round, and it's going to be $10 million, right? And instead of doing 10, they do 6 and take 4 of debt, right? That kind of thing. Okay, right? And they're doing it alongside a VC. So in a sense, that they get a lot of visibility and comfort because they're doing it kind of co-partnering with them. VC, and maybe it's only 2 and it's 8, going up to 10. I've seen those, and you continue to see those. But that's a company that's obviously a bit more substantial, right? The other thing you see, which isn't kind of venture debt, but you see people doing, financing of receivables.
Yes. Yep.
And that's can be a move when things start to get tight to try and pull some revenue forward. That's not uncommon.
Yeah.
Seems like there's more options out there than there used to be.
No,
Yeah. How about revenue-based financing?
I've always thought that should have a lot of potential, right? That's borrowing against the expectation of future revenues. I think I've seen it work, but mostly for companies that are in the smaller ticket kind of area. So a consumer company maybe would be an example of that. But if it's B2B, then of the smaller ones, where they're taking almost all of their money or a good percentage of it through credit cards.
Yeah.
So there's this credit card flow that the bank or whoever the lender is can point to and see. Yeah. And therefore have more of an assurance that if the revenue comes in, they're going to get their piece.
Yeah. Yeah.
And maybe even have a deal with that credit card, payment provider, the one that works with the startup to process their payments, actually gets switched over to one that's run by the person who's revenue financing. But at least they had that visibility into there so they can see that money moving through there. If you think about revenue, if it's checks coming in, and here it's a bit more challenging to know exactly. But again, I've always thought that the revenue approach is a good one. I just haven't seen it get a lot of traction.
Right.
I don't know what you've seen out there.
Well, not so much of the revenue-based financing, but the receivables, yes, and that has seen both, structured facilities that are recurring sort of receivables amounts per month, so you've got a balance that becomes available, and also then down to single. There's a couple of providers that focus on very single invoices to blue chip companies.
Yes.
And that is a great way to just, if you need to get a little bit extra capital in the door quickly, and it's a blue chip known provider, it's a sizable invoice on a contract, and it can be very beneficial just to get that forward.
Yeah, and I think most of the ones I have seen have been individual invoice ones, or any invoice you get from this company, we will be willing to finance based on this, and then from month to month they may be, factoring. I guess.
Yes, exactly. I think it's also easier to implement because a lot of those other sort of facilities that require like that. The money to be routed differently, which becomes very transparent to your customer base that you're actually using this facility for financing. Mm-hmm. So I think with some of these other techniques, I think it becomes something that you can really not hide, but it is behind the scenes. Mm-hmm. So you're not making it blatant to the customer base.
Just to hear, in your practice, do you see certain kinds of companies struggling more or less to get financed?
From that kind of
back on maybe more traditional equity or safes or that sort of thing. The base level of capital raising. Do you see certain sectors in the last 6 months or year, struggling more than others?
There's definitely a profile of customer, right, or our client right now, or company, let's just say, that there are some months past the last financing. They've got 6 to 9 months runway, perhaps at most, and there's not been as significant traction towards the milestones that they needed. Mm-hmm. And I think in the market in general, there's going to be a lot of companies in that kind of sphere. Mm-hmm. And especially we were talking to David Rose about this, about a lot of these companies raised money against business models that were selling to the tech environment. And so tech environments had this kind of like contraction. Now all the sales opportunities have maybe not dissipated, but certainly are much less. And these companies are finding it hard to sell. Mm-hmm. And so we were just talking about this at an event yesterday, some of these some kind of get drip financed, supported through sort of months of runway just in the attempt to get to successful conclusion. Yes. And it's a difficult way to manage your business, to sort of have that sort of, continually that the end seems almost just around the corner and then it gets pushed forward a little bit. So I think we definitely see some companies in that situation. And then others, there's a category then that raised money last year that just were, I don't know if I'd call it lucky, but certainly it was fortuitous that they raised a significant amount of capital. They've made significant cuts this year, and they've extended that runway out 2 or 3 years. Mm. And now they've got a platform in which they can really invest, and they can talk about, if they're at Series A or whatever, they're talking about product market fit, then once they really have determined that they've got there, then they can start investing in the sales and marketing side. Mm. And so there's definitely a category of client there that are just very well, they were lucky and fortuitous that they were well capitalized. And that when all this hit, they still had a good chunk of that left.
Had a good chunk of another. Yeah. Bit the bullet, cut back a bunch.
Yeah. We've seen a lot of that.
There's a fine line there, because I think that, that's exactly, as an investor, what I would want that company to be doing. Yeah. But on the other hand, unless they can get to good traction.
Yeah.
And good traction for VC world is you're doubling.
Yeah.
Right?
Right.
You can't. It's kind of if you can't get to that level, you're not exciting,
Yeah.
right? And therefore, you're not going to get to that next financing. So you can't cut your way to the next round of financing.
Forever. Yes.
Right. You can cut your way perhaps to getting to break even. You know, I mean, because that's a different sort of equation. But the only thing that's going to get you financed is growth.
Yeah.
Right. Doesn't matter what else is going on and how you can. Once you're more than an idea and you're out there, it's gonna need to be a metric story. Right.
Yeah.
So the cutting's great, but you need that you
still need the time
kind of
pressure.
you touched on it there, but getting to that market fit, which means like, all right, I'm starting to being able to sell, and therefore I can take some of that capital and throw some gasoline on the fire. Because unless I see that as an investor, I'm just going to wait.
Yeah. Well,
I'm going to say, great, I like the way I like your style, but come back in 3 months and show me 3 months of growth.
Yeah, yeah. No, and actually, just thinking back to another episode that we did with Victoria from Astia, she actually said something very similar, that she encourages certainly various of her portfolio. This is the time to spend. This is the time to actually be accelerating towards growth. So perfect.
Yeah. I think it was I was at a general meeting for a VC, and the partner was like, you can't cut your way to like growth.
That's a great point.
Right, and we all have these companies, and we're coaching them to cut and to make that runway last. But at the same chance, you got to have a plan to figure out how to grow, or none of that will matter.
Yep, very well said.
Got to ask you about AI. Johnny and I talk all the time. Who is actually making money on AI? Have you found any of those folks?
I don't know. Sam Altman, maybe? His net worth. Seems like he's doing pretty well. Google, maybe, right? At least,
sure.
The big guys seem to be doing well.
Right?
I mean, I think that it's a really interesting world. I get asked about kind of AI stuff, as I imagine you guys do all the time. And on one hand, I am very much a believer that it is a fundamental technology, and it will have, we're going to look back, even we can begin to look back now. We will certainly look back in 5 years and say this was revolutionary, like mobile, like the internet, big ones. And I don't think it's going to end up in one of those categories where it was a hype and it really fell out completely, like, VR or something that just hasn't quite found its. I think it really is a fundamental technology and is doing fantastic things. And if you look at what the models have been able to accomplish in the last couple of years, with simulating, writing and human speech and all that, it's pretty incredible, right? So I'm a believer. On the other hand, you can't help but think like we are in the middle of one big hype cycle, right? And that there are a lot of investments that were made in the last couple of years, right? Especially in the 10th LLM or whatever it is, that are not going to work out very well, right? And wow, it's great to be Chat GPT, but that doesn't really help me, right? And I don't think investing in a company that's exclusively using Chat GPT to try and create something probably is well founded either. So what do you do then as that investor who's wary of the hype cycle and but yet a believer in the thing? And what I try and look for is, stick to my guns. I'm a B2B investor. Look for a company that's solving a thorny problem, in the business world that AI can solve in a way, or the AI that they're using and other technologies, right, that couldn't be done maybe a year ago. Right, and that gives you kind of a clue that it's maybe not hype, that they are trying to do something which is fundamental. An example of one that we're about to close on is in the world of shipping, but in the shipping in the sense of like containers and air freight and sea freight. And they use AI to ingest the rate cards that are out there for supply chain movement of materials. So if you want to try and move a container from Singapore to New York or Singapore to wherever out of destination, every day or week those prices are changing, and they have about 6 or 7 different factors that can affect them. And then as soon as the Red Sea closes, right, or whatever it is, or the straits there's a fuel surcharge and all these other things. So they've trained an AI to be able to read those rate cards, summarize them, and then stay up to date reading the emails that are coming in with PDFs attached, or maybe they have an electronic connection, and make sense of that, provide a set of recommendations to you about this week or next week, where should you how should you be shipping, right? And then when the invoice comes in, helps you understand whether you actually got the rate, right? So to me, big problem, huge market, AI trying to do something really practical and useful. They could show me the model. They had already built it, right? They were in the midst of, probably their first 5-10 clients that that's an example of a company we got comfortable with that would say it's AI, or certainly got a huge, big chunk of that. But that's only one piece. There's a workflow around that whole AI to make that process I just talked about work.
Robust. Yeah, and I think that's a fantastic. And that paradigm, I think, translates to many other businesses. And certainly because there's so much hype out there, I think a good portion of it's hype about how AI is going to disrupt accounting. And there's so much of accounting, it really relates, I think, to the kind of workflow you're describing there, about what is essentially quite manual, is sort of lots of documents, lots of pieces of information that are disparate locations and whatnot. And I think it's going to be very feasible to have those LLMs tools actually trained, and you give it access to the data and you instruct it, or the questions you're issuing to it are about getting to the accounting the challenge that you're trying to solve. I think that's something that we're going to see definitely.
And I'm very much a believer in human in the loop piece of it, because I think it's that last, as we probably all realized at some point in our career, it's that last 1% or last 10% of making an automation that's the hardest piece of it. Although you can get a lot out of an application done the right way that solves 80% of the workload.
Yes,
for accounting, I could see that happening.
Precisely. And
where we pulled all the numbers out of things, presented a trial balance for you or whatever it was, and be like, and you have discoverability. You can click on a number and see where it came from, that kind of thing, right?
Well, when we see that, even just in the way that if you take AI out and you just look at it from a people perspective and the tools that we have available right now, SaaS businesses, 80% of the contracts are standard, and they're easily processed through a deferred revenue schedule, and it all just flows through nicely. And then 20% of the contracts are those one-offs, those weird things that happen because they needed to make a sell, they tried a pilot, and you've got to look at that and say, well, how do I squeeze that into what is a GAAP compliant model? And I think that same dynamic is going to exist in the use of AI. Like AI is going to take that 80% and make it really quick. And then it's going to give you sort of a starting point for that 20%. It's going to sort of give you a first assertion, like here's, some inference. We're not too confident about it. Why don't you take a look at it? And so I think the human in the loop definitely is going to apply to that, because not everything is going to be an ease. Not everything fits like a glove in terms of the way it happens.
And I think building, a piece of workflow software, right, that accommodates that, right, is a winning strategy.
Yes.
Ones that think they're going to sort of totally disintermediate something, I think is probably unrealistic. And I see smart founders, sort of having reconciled that, right, and built that understanding into what they're doing. It's also more believable, I think, to both founders and to customers, right, that they're, that this is something that's going to aid them, but not take them completely out of the loop.
Yes, I agreed. Hence, it makes it easier to sell to the customer at the end of the day. Definitely. Yeah.
So great conversation about an ever-changing world, but some great stuff, and I think some great insight for founders. Tom Wisniewski from Newark Venture Partners, thank you very much for joining us today.
Thank you.
And Johnnie Walker, my frequent podcast partner, always a pleasure.
Oh, very glad to be here, David. Thank you again, and thank you, Tom.
Yeah.
You can find contact information for our guest today at our website, theangelnest.com, where you can also reach me if you know of an interesting company or a topic we should talk about. I'm David Hemenway. We produce The Angel Nest with help from Rob Higley and with Charles DeMontebello at the controls at CDM Studios at the beautiful Art Deco Film Center building just west of Times Square in New York. Thanks for listening, and here's hoping my fellow investors and the founders they support find their next great venture. So long until next time.